Hello, I'm Melody Reagan, and welcome to 4Gen Now's Centennial Revenue Management webinar, Why Net Profits Don't Always Equal Good Cash Flow. Centennial Revenue Management is your advocate for financial health, providing fractional CFO and financial management strategies and services, in addition to easy-to-use financial management tools. With this presentation will be recorded, and we would like for it to be interactive. If you have any questions, please chat them, and we'll do our very best to get them answered. I'm pleased today to introduce you to Debra Robinson. She is the CEO and founder of Centennial Revenue Management, and she is going to share with you why net profits don't always equal good cash flow. Debra, would you please share a little bit about your background?
Yes, thank you, Melody, and good morning, everyone. I appreciate your time today. I am going to tell you two quick stories that helped me to share my passion for wanting to educate and coach business owners. The first lesson came when I was a CEO of a $40 million business, and I actually thought I knew what I knew about our financials in the business. I was taken by surprise when my own CFO embezzled monies from us, and I was actually held accountable for that embezzlement, being at the helm of a $40 million company. So that was my first lesson, and that was about almost 20 years ago. That was my first lesson of knowing that if you're going to be a CEO, you actually need to understand and know your financials. So that ignited my passion for educating business owners. The second experience that was life-changing for me was I went out and I bought a business and some real estate to operate it within. I knew my financials. I learned that lesson. I had about 20 employees. I had a lot of debt in that business, including the real estate I was operating within. What I didn't know was cash flow. So I operated that business for probably a year and a half longer than I should have. I did manage to go down with my dignity intact in that venture, meaning I did not go bankrupt. But the lesson I learned there from losing a lot of my own personal money was about cash flow. So I launched this business 10 years ago to focus on educating business owners on understanding their financials and also educating them around cash flow. So here we are 10 years later. So I have a lot of experience with other businesses that I've worked with. So I'm always learning lessons with each new client I onboard. So let's get started here. My promise today is to focus on and show you really several ways to improve your cash flow, to educate you on why it's important to understand your financials from a CEO's perspective. That's different than a CPA's perspective, by the way, and I'll help you understand that. To educate you on what numbers are important to pay attention to on your profit and loss. And let's not forget about the balance sheet. It's an important financial document that's often overlooked. To show you why you can have a profitable business and still have a cash flow problem. To help you with processes for accounts receivable, that's money coming in, and accounts payable, that's money going out. And I'm going to introduce you to what cash flow forecasting and modeling is all about. I actually developed this methodology from launching my business 10 years ago from my experiences from those two stories I shared. "82% of America's small businesses fail due to poor cash flow management, or they're not understanding cash flow." And it's somewhat of a startling statistic. I'm an overachiever, and in my second business I spoke about, I thought if I just change this process or optimize or do something over here in operations that I could get a different result. I kept banging my head up against the wall because I just didn't have enough cash, operating cash, just to sustain the model, the debt servicing and so forth. So I was one of those statistics. So let me ask, kind of rhetorically, what in your mind's eye, or if you want to answer in your mind, what does cash flow mean to you? Because it's a catchy term, and a lot of people, a lot of businesses, a lot of marketing goes around cash flow. So think about, what does that mean to you?
Payroll.
Simply, payroll. That was a good one. So cash flow means, can you meet payroll, is what I think I'm hearing from one of our participants. Simply stated, though, cash flow is really just the movement of money into and out of a business. So it's money coming in and it's money going out of your business. I actually have worked with, I launched my business, quick story. I launched my business originally to work with doctors and do focus on medical billing, because that was a medical practice's cash flow. And I actually had a doctor, because I didn't have the right letters after my name for education purposes, I suppose, that he actually said to me that his cash flow, he was concerned that I didn't have experience working with doctors. And he said his cash flow was different than a regular business's. So at that point, I learned very quickly when I should turn and walk away. Really, it's just about money coming in and money going out of a business. So how do you know if you're having a cash flow problem? Well, number one, a red flag would be you aren't paying yourself on a regular basis. If you find that you're always, as an owner, putting yourself in the back of the line because you're worried about making payroll, that's a red flag. You're having trouble making payroll, that's a red flag. You're juggling bills each month. How are you paying your vendor bills? Are you robbing Peter to pay Paul? That is a red flag. You are accruing credit card debt. Credit card debt really has no place in a business. And I think I talk a little bit about that, but basically if you're using credit cards and you're paying them off monthly, in my arena, that's good. A lot of business owners like to use American Express and get points and so forth. But when you start accruing credit card debt, it means you're overspending, and that's a red flag. Your line of credit continues to increase. That's also a red flag. A line of credit is meant to be a short-term support to help ebbs and flows in your cash flow, but it can't be used, and when you max out your line of credit, big red flag. Most important is, if you are staying awake as a business owner worrying about your finances, you're probably at least having a cash flow squall, if not a storm. So my first dirty little secret, and I'm always sharing dirty little secrets about cash flow, is you can be showing a net profit, but still be having a cash flow issue. So it's not always about net profit and net losses. Cash flow is really has its own claim to fame in the financial arena. So here's a pop quiz, and again, it's more of a rhetorical. Who is the most critical team member in accurately recording the financials? Is it you? Over the bookkeeper. The bookkeeper that is a good answer. That's the right answer in my arena. The bookkeeper is recording the day-to-day or weekly financial transactions. I've learned over the years working with business owners, it's a business function that is given the least amount of attention. This person, your bookkeeper, is responsible for following the money in your business via accounts receivable and collecting your money and posting it correctly in your bookkeeping and your accounting software, and for following the money out of the business, which is your accounts payable. The financial reports that are generated from your accounting software is based on the accuracy of the bookkeeper's activities. So if your bookkeeper is not staying current on your financials, and you're looking at, as a business owner, you're looking at your profit and loss, but your bank accounts haven't been reconciled for a month and a half or two, your financials are not up to date, and it's hard to make accurate financial decisions based on that. So I think bookkeeping is a critical function in a business owner's arena. So what I like to coach is, don't be fooled by the numbers. I have seen a lot of bad bookkeeping. In fact, it's one of the hardest positions, one of the hardest subject matter experts I have found over the years of fulfilling that role to a business owner. A lot of bookkeepers are, they just don't know how to follow the money and accurately record it. So what I mean by that, by following the money, is make sure that your bookkeeper is doing monthly bank reconciliations, and not just on a bank statement, but they've got to do reconciliations on credit card statements, on loan statements, even on line of credit statements. I've come across, so if you're a business owner, first of all, and you are doing your own bookkeeping and you're just winging it because you don't know how to accurately record or do a reconciliation, you're not doing yourself justice. It's it's a minimal cost to outsource your bookkeeping, and it's not a highest and best use, in my opinion, of an owner's time to spend on this function. So by following the money equates to doing all bank reconciliations. One of the weak areas is credit card statements. I've seen all kinds of workarounds with bookkeepers who have minimized the importance of tracking all the monthly charges on a credit card statement, for example, and then reconciling that statement. Oops, wrong way, my bad. I apologize. Got carried away on the bookkeeping. So I like to also coach the concept of having numbers with integrity. In my arena, the end goal is to be able to do forecasting and modeling. So if the financials do not have integrity, then my forecasting will not be accurate. So to confirm, as a business owner, to confirm your numbers have integrity, make sure that you have your bookkeeper provide reconciliation reports back to you with a bank statement. So one way or the other, you should be at least looking at a bank statement when you're giving it to the bookkeeper, or afterwards, and have a reconciliation report, and at least spend a few minutes looking at that. Look at your balance sheet. You look there for end of month balances. So especially on a credit card, that balance should match on the balance sheet. That should match your credit card statement as well as loan balances. Third, and this is always a critical statement in my working with my clients, is do not commingle personal and business money. So make sure your bookkeeper is holding you to that high standard. One area that your bookkeeper can help, or you can hold your bookkeeper even more accountable for, is how to protect your own money. So number one, these are questions I ask all the time going into a first-time visit with my client, is do you sign your own checks? Or are you letting your bookkeeper or your CPA sign your checks? Do you use online banking? Do you review your monthly bank and credit card statements, or are you just can't be bothered with them? All of these areas are opportunities for embezzlement. And when I'm going to go back to the slide for a second and go back to online banking. This is an area that a lot of business owners like the convenience of online banking, but you're opening a portal for a bookkeeper to be able to send money, someplace that if you're not watching your bank statements down to the details, it's an easy area for an opportunity for embezzlement. So my dirty little secret about bookkeeping is I call the bookkeeper is the keeper of the cash flow, and try not as a business owner to minimize the importance of this function. So if the bookkeeper is the keeper of the cash flow, what is the role of your CPA? Do you as a business owner, are you relying on a CPA for helping you with cash flow, for tax compliance? Does your CPA, are they your subject matter expert for wealth management? A lot of business owners like one-stop shop.
To keep you out of jail, not out of trouble.
Say that again?
To keep you out of jail, not out of trouble.
Oh, if you violate IRS rules. So that would be a good bullet, to keep you out of jail. Very bold, very bold. Well, a lot of business owners try and combine all of those functions under a CPA role. But I'm here to tell you that a CPA's role is tax compliance. Their job is to make sure that you are following all the IRS, all the state, all the county rules and regulations for reporting net profits and net losses. So optimizing cash flow it takes implementing proactive strategies. I'm going to tell you, and I don't know if I have any CPAs on the call, but CPAs are mostly reactive. That's their training. When you sit down with your CPA, when you meet with them, they're looking at, well, here's where you are, and they look in the rearview mirror to see how you got there, and they're going to tell you how much your tax liabilities are going to be. So most CPAs are reactive. They just are not proactive thinkers. They're rearview mirror thinkers. So keep your mind's eye on having your CPA stay focused on net profit, on tax strategies. They can be a help in debt servicing as well, because a lot of business owners don't understand that debt servicing doesn't really help with mitigating tax liabilities in the big picture. So does your CPA educate you on how your business profits and losses pass on to your personal return? Most of my clients are structured as an entity of a small, as a sub-S or an LLC. So most of the time, all of the times if you're structured that way, your net profits, net losses are flowing through to your personal tax return. I don't think a lot of business owners understand the impact of that. And a good example, there's many types of examples, but a good example of making this point is whether you're, as an owner, taking W-2 wages plus owner distributions. If you're an LLC, you might only be taking owner distributions, and those are not being reported on your profit and loss. So very quickly, to help you understand, W-2 wages, so your owner's wages are going to be reported on the profit and loss statement. The business has a burden of also covering your wages with payroll taxes. The IRS simply states as a rule of thumb that an owner has to take a reasonable salary. So there's lots of wiggle room in there. And I often am looking to work with my client CPA to give us guidance on what is a reasonable salary for the size of their business to help not raise a flag to the IRS. The other side is owner's distributions. They're the same as dividends, owner's distributions or dividend payments. The important thing to understand is those are being reported on your balance sheet, and they don't have anything to do with with whether you're making a profit or a loss. So it's important to understand those two entities. And actually, let me go back here for a second. I look to the CPA as well to be the subject matter expert in helping a business owner understand how should they split. So a lot of times business owners ask their friends or colleagues or not the right subject matter expert, well, how are you doing it? Are you doing a 70% of my wages, or if I want a total compensation, for example, let's say the total compensation will be $100,000 for owner's salary. Do I want 70% to be over on wages and 30% to be in distribution? I strongly encourage you as a business owner, that's a CPA question. They can help you manage that and make sure you're not raising any red flags for the IRS. My seat at the table as a cash flow person, subject matter expert, is to make sure that you're not rating the business with taking too much in distributions, and also just helping keep an eye on cash flow. So two perspectives on that. Does your CPA give you quarterly tax estimates? I am so surprised way too often to learn that CPAs will do a tax return and the owner's surprised in April that they owe $10,000, $20,000, $30,000. And how is it that it just is a surprise to the owner? So again, remember that CPAs are rear view mirror thinkers. So it's up to you as a business owner to advocate for yourself and be proactive. So your CPA should be most of the time giving you quarterly tax estimates to help you with cash flow projections. By giving you these estimates, it allows you to model future business strategies, because now you know that you're going to hold on to some money, or you're paying out, you're building up reserves to pay your quarterly tax estimates. With my clients, I coach them that when you are signing your tax return back in April with your CPA, number one, he or she should be giving you tax estimates for 2018. So you do have a roadmap to follow. You and your CPA should be meeting, again, I just mentioned in April. So that's just a quick phone call. So Jen, when you're signing that tax return, my advice is to take a telephone call at least, if not meet in person, and have your CPA explain how did your net profits from your business flow over to your business return, your personal return, and make sure you understand how that all works. In April, they'll give you quarterly estimates. I suggest that you meet in July and do a mid-year review. And the main question you're going to ask your CPA in this meeting is, what are my projected tax liabilities going to be? So you're already starting that conversation. In November, you have maybe another meeting to do a check-in and see if there's strategies that you want to execute before the end of the year. And December is just a quick phone call for any end-of-year adjustments. A lot of times that is involving, if you took too much in dividends, that you might want to flip those over to payroll so that you don't overstate dividend payments. And this is also an ideal time in April and mid-year to evaluate W-2 versus owner distribution. So you and your CPA should have a meeting of the minds as to what you're expecting. He or she should be your subject matter expert. You should agree. I mean, if your expectation is they're helping you with cash flow, make it loud and clear with the CPA that you're considering him or her to be an expert. And who is in control of when to meet? I strongly encourage you to be proactive in scheduling those meetings. My dirty little secret about your CPA is that they are your tax compliance expert. And even if they tell you they can do cash flow modeling and forecasting, I haven't come across too many CPAs that are an actual expert in cash flow management. All right, so you've got a bookkeeper that's a subject matter expert of your bookkeeping. You've got a CPA that's the tax compliance. The next component of good cash flow is within your accounts receivable. I often am surprised that business owners just allocate this function or delegate it to the office manager. I really encourage business owners to plug in on a monthly basis of what their accounts receivable is. AR, accounts receivable, simply stating it, is it's money coming in. So we want that in the cash flow arena to come in as fast as possible. It's a major component that optimizes cash flow. It may or may not be tied to an accounting system. So I'm stating that in that a lot of, if you're in the building industry, construction industry, you might have construction software. And so owners tend to watch that software and look at what they're waiting to be received or what money has come in. And that's more often than not is on an accrual basis. So we want to follow the money into your bank account. So what I mean by the last bullet is collections. If you've collected money but you haven't received it, that doesn't equal revenue. It has to hit your bank account to equal revenue. I recommend that you review AR reports at a minimum of once a month. I actually prefer that you do that twice a month, mid-month, so you have a chance to collect any outstanding receivables before you close the month. I recommend that you understand how this is being reported on your balance sheet so that you can follow the money onto the balance sheet. And oftentimes owners tend to hold on to overpayments. As a good process, I recommend that you refund overpayments monthly or make sure that you have a credit that will be used in the next 30 or 60 days. Otherwise, don't let that accrue as money that's not yours. Give it back. Owners need to learn how to ask for money owed. It's a hard a lot of small businesses, business owners are doing the work, and especially if they're a service-based industry, and they're not comfortable asking their client for money. So in that regard, I encourage there to be a good process where you do have an office manager that's overseeing an AR process, and they're the ones that would be making the phone call to the client, not you as a business owner. So your job is to hold somebody that you've delegated the collection process to hold them accountable. I can't quote a statistic where I know this, but I've over the years, I just have come accustomed to stating that you have 45 days to collect a payment. So if your due date is on the 30th of the month, and there are 45 days after that, your time of collections is dwindling. The opportunity to collect that money, it's harder and harder to collect that. So here's some important components for a good AR process. Number one, it's everything is tied to your financial policy or your contract that you've had your client sign. In this document, you are setting the expectation of how you are going to collect your money. So it needs to be right up in front so that your client understands this is how you expect to be paid. Balance bill, what I mean by that is send a statement as soon as you've reconciled a payment. So a good example would be in a dental office. When you go, you might pay a deductible, but often not. You just they're going to bill your insurance. So I recommend that balance billing happens, meaning when that insurance claim comes in and there's a balance that gets transferred to the patient, that the dental office charges the credit card right away, or the statement is sent out right away. So once the payment is due, 21 days if you have not collected the payment, I recommend doing a client relation call. And what I mean is, don't make it about you owe me money. Use it as a client touch, or your office manager to use it as a client touch. And that means, Debra, we sent you a statement. Do you understand what you're being charged for? Do you have any questions? I'd be happy to take a payment today with a credit card. Client relation touch. In 30 days, you're going to send a past due statement. In 37 days, if you still haven't collected your money, you're going to do more of a collection call, a little bit more assertive at 37 days. And at 45 days, I recommend that you start a collection process. And there's many different aspects. You can do soft collections. I'm not saying that you just throw it over to a collection agency, but oftentimes owners run into a problem where they didn't clearly create that collection process. So now they're stuck. Now what do? You don't want to threaten your client. So just ensure that you have a collection process that you can implement in 45 days. So my dirty little secret about accounts receivable is that don't just rely on your office manager. You need to be plugged into it on a monthly or bi-monthly basis. Accounts payable, that's the other side of the equation. Again, who's responsible for accounts payable? Who's overseeing that process? And this is about managing your vendor bills or your credit card payments, money going out. So whereas on accounts receivable, we want money coming in as fast as possible. For payables, we want money to go out as slow as possible without violating any payment terms with your vendors. Don't take care of your accounts payable the same way you do as with your personal bills. If you're if you're at home, if you pay your bills as soon as they come in because you just don't want to be bothered with them and you want to make sure you're not a late payer, that strategy doesn't serve you well in the business arena. So I suggest that we have structure to an accounts payable business. So again, we want money going out as slow as possible. Have your bookkeeper pay attention to vendor payment terms. So when they're logging invoices, you want to make sure if they're offering terms that your bookkeeper is putting that in and you can take advantage of the net 30. Don't give vendors your credit card. A lot of times business owners think it's just easy, let them charge my credit card when the bill is due. Nothing about managing cash flow and money should be made easy. You should have clear You should have structure and you should have process to follow. So if you want to use a credit card because you want to use your American Express, go ahead and call that in, but don't give the right away to your vendor. And again, create a process to pay bills, either weekly or biweekly, and prioritize payroll first and then vendor bills. So to tie accounts receivable and accounts payable together kind of quickly in a big picture arena, we want accounts receivable to come in as quickly as possible. So if you're having a payroll, and everything sort of focuses around payroll, if your payroll is twice a month, we want your payment terms to come in not on the 15th of the month, but maybe on the 10th of the month, so you get more money coming in before payroll. And again, maybe you might have payment terms that are on the 10th and the 20th, for example, especially if you are doing credit card on file from an accounts receivable standpoint. So try and collect your money before payroll. And the other side of the equation is you're going to make your vendor payment after payroll. So that would be after the 15th and after the last day of the month. So do you have an AP process in place? And if not, why not? So my dirty little secret about accounts payable is by not tracking vendor invoices and instead, if you're just trying to make it easy and paying from statements, you're likely overpaying your vendors. I always say the devil is in the details. So it's really important to track the invoices to make your payments on a monthly basis. Same with credit cards. You need to be logging all of the credit card charges on a monthly basis. Second dirty little secret about accounts payable is look at your balance sheet to see what the total amount available is in your checking account before paying your bills, not your online banking. The balance sheet will have what money is left after uncleared checks haven't cleared your bank. So if you're using the online banking, there's probably checks that are in play that you don't have eyes on. So check your balance sheet for how much money you have. So let's move into, so we've got money coming in, money going out. So how are we reporting the activity? And that would be your profit and loss or your income statement. So a lot of times owners just, they don't look at their profit and loss or their income statement on a regular basis. Recommendation with bookkeeping is I strongly encourage you to have your books reconciled the first week of the month, so that then your bookkeeper will print a profit and loss and a balance sheet, by the way, that will give you the most accurate financials for the previous month ending. So your profit and loss, I like owners to look at it on a bi-monthly basis. So the first week of the month, and then I'd like the second to third week of the month to see how you're tracking. Customize the report by adding a year-to-date percentage column so that you can have some comparison. Or I often will do a comparison of this time, where am I this time versus this time last year, so I know if my business is trending up or down. And also, where am I spending the largest amounts of money on my profit and loss? Look at your P&L on a cash basis instead of accrual. And the importance of this is following the money into your bank. So when you're doing cash flow modeling and managing cash flow, we need to see how much actually hit your bank against how much went out that month. I always am coaching that your report card should be, or your profit and loss should be a report card of how your business is performing. Most of the time, the way your profit and loss is being structured is driven by your CPA, and their focus is on a tax, to help them report your taxes, or from a bookkeeping position, which is usually underneath the CPA's perspective. So I like this to be a reflection of how do you watch your numbers? How do you know if your business is performing well? So by a report card, we need to know what your financial story is. And for example, if you have a variety of revenues coming in, your profit and loss shouldn't just say sales. It should say sales, and I'm going to defer to a dental office again. It's easy to use that as an example. In a dental office, they get insurance reimbursements, they might have care credit, they might use Delta Dental, and then they have cash services. So I would have their revenue story broken out into those categories so that I would know what is their revenue story. What is your payroll percentage to revenue? That tells the story. What is your supply cost or your cost of goods to revenue? Most important, you need to know how profitable. So I call this the drop to the bottom line. What is your net profit to revenue percentage? How profitable is your business? Here's an example of just one of the columns. So we're using a comparison of percent to revenue. Here's my dental practice. So in this example, you can see that if you go to the far right-hand side, percent to revenue, the revenue story here is that insurance reimbursements are 32%. Delta Dental is 11%. Now, why is this important? Well, if the dentist says, I don't want to deal with Delta Dental anymore, I can very easily help them see that, well, you're going to have to replace 11% of your revenue if you want to do away with Delta Dental. Dental supplies. So you go down the right-hand side and you're looking for big outlays of cash, because if you're going to create a strategy to improve cash flow, you don't want to spend time on office supplies, for example, is 1.6%. I go to advertising and promotion or computer and internet expense and drill down in those categories to see, are you managing those areas well? And then come on your payroll, the percentage, 37%, that tells the story. For every dollar coming in of revenue, 37 cents is going out for payroll. Most important on the bottom line is your net profit or loss. In this case, it's 27.1% profitability. And then the cash flow, in my sandbox for cash flow, I start with a 10% drop to the bottom line. So I'm coaching my clients or listening to their story when I first go in or looking at their financials. Is there a 10% drop to the bottom line? Because I often find that's the starting point for good cash flow or not good cash flow. So cash flow doesn't always have to do with just net profit or loss. Certainly if you're running at a net loss, you're probably feeling a good squeeze on cash flow. But in this example, and I'm going to walk you through, even though this is a profitable business, they're still going to experience a cash flow problem. So my dirty little secret about the profit and loss is knowing which numbers you should be watching and then giving energy to wrangling in or creating better processes to manage those expenses on your profit and loss. So tax strategies versus cash flow. So your CPA, again, is trying to help minimize your risk of an audit, but they're also trying to drive down that net profit because the more profitable you are, the more taxes you're going to pay. So the CPA is trying to drive down that net profit. My seat at the table as a cash flow consultant, I need to have you maximize your net profits for better cash flow. So really, we're kind of in two different perspectives of helping our clients. So CPA is looking at helping to reduce your tax liability. I'm helping to try and improve your cash flow. So it's good for both of us, for both subject matter experts, to be working together to serve the same client. So my dirty little secret is a 10% drop to the bottom line is a good starting place for good cash flow. So CPA tax compliance, they're reactive. Cash flow consultant, I'm very proactive in looking down the road at your cash flow requirements. So it's really a good idea for an owner to surround themselves with both types of subject matter experts. I haven't gotten any questions, and if there are any questions, I'll wait for Melody to raise her hand. I'll keep moving through.
Yeah, by the way, just so you know, Debra, I'm holding on to the questions to the end, just so you get through, but we do have a couple of questions.
Okay, very good. I'll keep moving through then. So the profit and loss is the report card of how your practice or your business is performing. So what is the purpose of the balance sheet, you might ask? The main reason to look at your balance sheet is any of these rhetorical questions you might ask yourself. Most of the time, business owners, when I step into a new client's arena, they're not familiar. They don't understand their balance sheet. In the cash flow arena, the money story continues on your balance sheet. And this is where, believe it or not, a lot of dirty little secrets about your cash flow reside. So the balance sheet is a running total from the time your business was started. So that in itself makes it a bit cumbersome for a business owner to understand. You've got on the balance sheet, you're reporting assets, which are your bank accounts, your receivables, any assets that you own. It's looking at your liabilities. What money do you owe? And equity. And equity, this is where your owner distributions would be posted. But also retained earnings is a number that I coach my clients to understand, because if you have a negative retained earnings in your business, your CPA should help you manage that, because by definition, without getting too technical here, if you have a negative retained earnings, you cannot take out, you don't have what's called a cash basis to take out distributions. So we rely on the CPA to help manage that. Do you look at your balance sheet on a monthly basis? And if you don't, I highly recommend that you do. So your bookkeeper should print a balance sheet, profit and loss. So we are starting a new month in October. So by the end of this week, I recommend that your bookkeeper has given you a profit and loss ending September and a balance sheet ending September. So this is what you probably, if you are looking at a balance sheet, you're normally getting. It's just one column. It's showing you, most important that you could look at is your checking account and savings account, because this is telling you how much money are you going to start with in the next month, in this case in April. Here's your accounts receivable. You've got your assets, liabilities, your business loan. We've got a business loan here of money that's owed. And then we've got our distributions. So identifying distributions, we have a negative $100,000 there. Again, that's from the beginning of time. So this does not tell us a story here on your balance sheet. And I'm always looking for the story in the numbers. So I'm going to recommend that you add a column to your balance sheet. So in this case, I added a 30-day window. So on the left side here, we've got our balance sheet ending for the month we are ending. But now I've added a 30-day window. So this gives us how much money got posted in the last 30 days, and that's reflected by this column over here. So we can see that our accounts receivable changed position by $10,000. That's not the most important number. So again, I help identify what are the most important numbers you should be watching. Well, right here in red, this in the last 30 days, we purchased $1,500 in office equipment. That doesn't have anything to do with profitability at the moment. So we've got $1,500 here. We paid off some credit card debt, and here's the principal. So when you're servicing debt on a business loan, you've got interest on the P&L, but you've got a business loan principal over here. And here's our shareholder distribution. So that's important. That tells us a story. I can see in the last 30 days how much cash got posted to the balance sheet. So my dirty little secret about the balance sheet is to actually print it on an accrual basis, not a cash basis, because when you print it on a cash basis, you don't see your AR and your AP. I'm not going to say very much about debt servicing, except that very little of this activity affects the profit and loss. And so you're watching this on your balance sheet, right? So your loan, your principal payments are being posted over to your balance sheet. Your credit card servicing is over on your balance sheet. And this is just a quick example that only the interest is over on your P&L. So the majority is going to the balance sheet. So you need to pay attention to the effect that servicing has on cash flow. And I always recommend having a strategy. Don't wing it with trying to service debt. You need to have a strategy. And I'll add to this that it can't always be, if you're a profitable business and your CPA is trying, to help you with tax strategies, they might not talk a lot about debt servicing because it doesn't help you with tax strategies. But it is good for the health of your business to have strategy to service debt. So here's the big question. How can you be making a profit but still have a cash flow problem? So let's go back to our profit and loss. On this example, going down all the way to the bottom line, we are 27% profitable. We've got $258,000 that we made profit on. CPA is not going to like that because that's taxable. Or portions of that is taxable to you on a personal level. From a cash flow level, I'm saying, well, you're above 10%, so that might be okay. But I know this business and I know they have debt servicing. So I'm going to go over here to look at what is being posted on the balance sheet. So we know you've got fixed asset purchases, loan payments, credit card, owner distributions. So let's follow the money over to the balance sheet. And right here, if I add up, now this column is in a year. So I'm comparing a balance sheet for a year's view to see how much money posted on the balance sheet. And I'm going to add up these columns. I service $12,000 in credit card debt plus $4,000, but here's the big number. And this is true for a dental office, by the way. Just to hang their shingle, they have to buy a lot of equipment. So they had $96,000 in principal payments. They took out $100,000 in owner distribution. So that's a total of $217,000 in cash that you don't see on your P&L. But I'm going to break accounting rules, and we're going to create a report card balance of your income statement. Here's my $217,000, and I'm going to subtract that from my profit that we reported, and I'm left with only $41,000 or 4.3% profitability. So on a monthly basis, I'm showing this to you on an annual basis, but on a monthly basis, they've probably been having trouble with cash flow and with the ebbs and flows of paying their bills and making payroll. So that's how you can be profitable, but still have a cash flow problem, is the components that are being posted on your balance sheet. Cash flow forecasting. So this is my methodology that I created from my experiences with the two previous companies. So cash flow forecasting and modeling in my arena is based on a 4-month trend. One way or the other, money's coming in and going out, and it tells me a story about your business. It combines both profit and loss, so expenses, revenues, and balance sheet or debt servicing. It forecasts, I'm taking a 4-month trend, but I'm forecasting 8 months into the future. I also come up with a working monthly budget. So based on a 4-month trend, I'm giving you a monthly budget. I don't believe in budgeting for 12 months out because things are more accurate, reflected as of today. My important numbers that I teach my clients is monthly cash outlay. So that's expenses plus debt servicing plus dividends equals cash outlay against projected revenues. It allows for you adding unexpected or out of the norm payments, such as quarterly tax payments and other unusual expenses. It also helps you or allows you to try on a financial strategy before you execute. So if you're thinking about hiring a new employee, we can put that in the model to see, is there a burden on cash flow? So cash flow, here's a dirty little secret about cash flow managing. Cash flow forecasting is not about the next 30 or 60 days because that money's already in play. We look out 90 to 120 days to see if we can get a different result by changing a strategy today. And this is an example of my model of a cash flow forecast. And the important components, real quickly, that I'll walk you through is we're starting with the beginning cash balance up here. So based on my balance sheet, I started with $65,000 in the bank. My trend of revenues is $72,000. And here's how my money's going out here. And in red over here, these are my balance sheet items. So this was all the money we calculated off the balance sheet. So on a 4-month trend, my outlay of cash is $79,000 and change. Well, what I just learned here, and I'm showing you, is our average revenue is only $72,000, but we're spending $79,000. And that's not to account for any extra money, which I'm showing down here, quarterly tax estimates, equipment purchase, whatever. So on average, we're already spending more money than we're bringing in. And you can see my ending cash balance, you can see that I'm going to drive into a negative. So this money over here is already in play. but can I create a strategy to get a different outcome? Easy one, the first one would be, well, I might have to go on a line of credit to put more money in here so I don't run out of money. But that's what cash flow modeling is all about, or forecasting. It's not about the 30 to 60 days. What is happening out here, and when am I going to run out of money? So cash flow forecasting helps you to create strategies and make smart business decisions. It helps you to answer questions. When are you going to run out of money? Can I hire a new employee? What will happen if I buy new equipment, or should I take on a new loan, and how will that affect? Is it a black hole, or can I service that loan? So dirty little secret about cash flow, you need to know what your cash outlay is, and that's different than total expenses against projected revenues. And that's what I help teach and educate my business owners. So what if you had total understanding and control of your cash flow? Could lead you to empowerment and peace of mind. So we have created a app that models my cash flow that I just walked you through. And we call it the Total Cash Clarity app. And we're going into a pilot test program of it. And it's a custom cash flow forecasting app that you get to put in what you upload your own information, and then we give you a projected outcome of what will happen to your cash. It's easy. The app is easy data input and editing. It combines both the P&L and the balance sheet items. It projects 8 months into the future. It gives you your most likely outcome of what will cash reserves look like. It allows you to forecast and model tied to your current financials, and it allows you to do some what-if analysis. So in the app that we're going to offer we will be offering a subscription to, you get a cash flow tutorial from me, you get access to my tips and dirty little secrets library, we'll be publishing how-to video libraries, and you get a discount on some of my services, and including some coaching. So in order to sign up, I'll leave this up on the screen for a minute. This is where you can go to this website, and you can put in a code 4Gen Now for the summit, and we are offering this through the 31st, and it will give you 90 days of free use of our cash flow app. So, questions?
Actually, Deborah, just super fast because we are out of time. I did get a question from Frank. He was asking, you speak to a CPA. Do you really need to have a CPA, or can you just engage with an accounting professional?
My answer is you can engage with an accounting professional, but I recommend that you surround yourself with a subject matter expert, and that would be an actual CPA. Remember, their job is to keep you out of harm's way, and so you want the complete expertise behind that professional.
Okay, one other question when you think about cash flow. So we have a question from Joel of, what's the difference between cash and accrual, and what's the impact on your cash flow?
Yeah, so when you have accounts receivable, so if your business actually has a high accounts receivable, and you're trying to do forecast and modeling, if you look at it on an accrual basis, it's accounting for money that you're expecting to come in. So the difference between accrual and cash is accrual says, here's your financials based on money coming in that is owed to you and money going out that you owe to your vendors. On a cash basis, it's a line in the sand that says, at the end of September, we closed our books by reconciling to this bank statement. So we are not watching accounts receivable. Well, we can watch it, but it's not counted as our revenue. So in cash flow modeling, we want to know how much money is coming into the bank, not including how much you're expecting. So cash basis, simply stating, is it's a line in the sand that says, as of this point in time, this is what you're going to report to the IRS, and you don't pay taxes. Most businesses will do cash accounting for that purpose.
Fantastic. Well, Deborah, I just want to say thank you so much for a very insightful presentation today. We're going to go ahead and close, but just to wrap, I want to remind everybody that Centennial Revenue Management is your cash flow expert. Centennial Revenue Management provides fractional CFO and financial management strategies and services, plus easy-to-use financial management tools. As Debra shared with you today, quick reminder, you can get 3 months access to her Total Cash Clarity app to model your monthly cash flow, and it's for free. Sign up at centennialrevenuemanagement.com/get Total Cash Clarity. And Get Total Cash Clarity has dashes in between each word. And just enter coupon code for Gen Now, and that is GENNOW for Gen Now. Select the quarterly subscription when you do that. Thank you again for joining us today. We hope to see you at the upcoming 4Gen Now seminar. And on Friday, Debra at 12 o'clock will be facilitating a roundtable session. So please come on by and meet her. Have a great day, everybody.